Welcome back to the OPTIONETICS DVD series. Our intent during this DVD series is to show you a bunch of different strategies, the risks and rewards of trading, and to teach you how to go up the learning curve really fast. Hey Tom, good to see you again.
You too, George.
What we're going to teach you during this DVD is specifically a strategy called Debit Spreads. And it's just one of a series of strategies you're going to want to learn as a trader. And there's just so many different strategies, and these are one of our favorites. It's one of the basic beginning strategies, but it's also a great one for you to learn. Tom, what is a debit spread?
Well, actually, a debit spread involves the use of more than one option here, folks. In fact, this is the best one to get started on if you're going to get started on any type of spreads. If you've never done a spread before, this is a great first place to start. And so basically, it's a combination of more than one option. And so you can, you can do any different types of spreads, but the particular debit spreads we're going to involve today are using calls and puts together, meaning one will be short and one will be long. And basically, the difference between the two will still be a debit to your account, although it could be considerably less than if you were buying a single option outright.
I have a question for you, Tom. Let's break it down a little bit. Okay, first, a debit means what?
Debit means that regardless of the trade, monies will be pulled out of your account, and then the actual option or whatever it is you're purchasing will be replaced.
So it's kind of like having a debit to your bank account. Money goes out, where if it was a credit spread, which we'll discuss at a future point, you're going to be bringing money in.
That's
okay?
Right.
So the term debit means that money is going out. So in essence, if you pay $100, there's $100 out. How about spread? What does the term spread really mean?
Well, it basically means that we're looking at buying an option and we're financing that position by selling another option. The combination of the two is what is referred to as the spread. Putting this on will give you a limited risk. If you do it on a 1-to-1 ratio, which we're going to talk about, you'll have a limited risk. You will have a limited reward now, because what we're doing is we're trying to make money in between the spread. The distance between the spread is where we're going to make our money. So, even though the stock could go outside of the spread, the distance between strikes is where our maximum profit is going to come in at. So limited profit, limited risk. That's what a spread is.
So really what you're doing is, in the same expiration month, in the exact same period of time, we're going to be buying something that creates a right, and we're going to sell something that creates an obligation. So you're going to have rights, you're going to have obligations, and if they're in the same time period, they're going to offset each other, and certain rights and obligations are going to occur. We're going to lower the cost by buying something and then selling something against it. We're going to lower the risk. We're going to do, what's the break even? How do you describe that?
Well, the break even on an option, as you learned in the last session, is that we're going to look at the strike price, and we're adding on the premium, and that's going to give you a break even. Well, the same thing is going to happen with a debit spread. We're going to take the lower strike price. We're actually going to take a portion of the debit spread, and we're going to add the premium to that. But the premium is going to be a lot less. So what happens is it's going to actually have a closer break even to it.
So really what you're saying is, as an example, if you buy something for $5 and you sell something for $2, you've really lowered your cost, but you also lower your break even.
That's right.
Okay. How about the stress involved about doing debit spreads? What do you think about that?
Well, if you combine the medium to longer term options with a debit spread, you will substantially lower your risk. And as long as you don't go throwing all of your accounts into that one spread, a lot of people will think, hey, I can do the same situation, let's say with eBay, where it would have cost me $5 over here. It's only going to cost me 50 cents with the spread. So I'll do this spread and I'll do it times 10. And that's not proper money management. But if you looked at it on a 1-to-1 ratio, between the long stock and the spread itself, then you will substantially lower your risk as well as your stress.
So in many cases, the stress in trading really comes from a couple things. One, not understanding really what you're doing yet, or number two is putting too much money in a trade, and that's one thing we don't want them to do.
Right.
How does a debit spread or a spread affect your return on investment?
Well, let's take a look and see. On the next graph I've got here, we've got a spread risk graph, and this is just a simple, we don't even have any dollars or anything put in here, but the way a spread is designed is to risk much less than you would on an outright option. And then on the other side, you have the ability to make a good amount of money here. If we have it here, risk a little, make a lot. You can set spreads up to where you can make 2-to-1, 3-to-1, 4-to-1, 5-to-1, or more. And what it's basically boiling down to is how much money of that spread are you putting into the debit, and then what is your possible return. And looking at that and judging it against a call option, a lot of times times you will see a better reward to risk ratio just by simply being able to lower that risk on the front end.
Well, that's where we get a lot of those questions is when do you use a call option, which is just buying an option, which you saw in the first DVD, in the intro part of our DVD series, versus doing a bull call spread or any bear put spread or these debit spreads we're going to review. A lot of people are confused as to when to do one versus the other. So we're going to discuss that during this portion of the DVD so you can understand that. Let's first discuss the very first and the simplest debit spread that most people understand, the first spread called the bull call spread. What is a bull call spread?
Okay, well, a bull call spread is basically, it's a debit spread. We know that first. And because it's got the terms bull call in it, we know that this is a bullish trade. So we're going to be using it in stocks that we're expecting an increase in price from. Now, I'll tell you right now, I'll say it now in case I don't say it again, is that I like the bull call spreads, and I like them on longer periods where I expect something to move over a long time frame. You know, that's where a spread makes a lot of sense to me. So let's go through some of the objectives right now. I've got them on the computer screen here. So first, it makes profits through a bullish move of an underlying stock. Number two, what we're going to do is we're going to buy one long call and we're going to sell one short call to maintain a limited risk position. Basically, it's a one-to-one situation. It will not be unlimited because you will be covered by the call that you're long. Number three, reduces the cost versus a long call. I'm going to show you this actually on the computer, showing you how we can reduce cost. We'll pick a trade today, and what I'm going to do is compare it, the long call option versus the actual bull call spread. And you can see it right there with the quotes, how in many cases, if you do it correctly, your bull call spread will be much cheaper in value. And then number four, and I'll turn it back over to you, George, is it reduces the day-to-day fluctuations of profits and losses. And this has a lot to do with how you structure this and how much time you have to expiration.
Sure. The other thing you want to understand is that the bull call spread in some cases is also, if you ever hear the term long call spread, could also be used in that way. We do use bull call spread primarily, but long call spread is definitely something you're going to hear quite a bit. Once again, the important thing here, the reason we're doing this is we're really reducing our risk. And typically when you're going to buy just a call option, you're going to be a lot more bullish than just doing a bull call spread. Is that correct, Tom?
That's right. And let's look at some key points in our overview here. Number one, we're looking at bullish and low volatility. This is a debit spread. It has a maximum risk which is limited, which is equal to the debit. It has a maximum reward which is also limited. It will reduce the cost of your bullish trade, and it may even reduce the break-even in a lot of cases. It will. We typically like to see this on options that are greater than 90 days because of the fact that you're looking at a reduced delta. Your directional risk is very, very low. So what we need to do is we need to push this back beyond the 90-day point so it has a maturing rate to it. It has rights and obligations, which we're going to cover, and we're also going to talk about in the money, out of the money, and at the money, and where to place this spread.
Sure. Yeah, let me spend a little time in here. Just once again, remember to simplify for those of you who've never done this before, you're just going to be buying a call option and selling another call option in the same time period, expecting a bullish move. A bullish move means you want an upside move to the market. The market should go up. And once again, you're going to reduce your costs of doing the trade by buying something, selling something else, but you also reduce your risk, which is something we like to do as traders.
That's right. Let's get into exactly what this entails. For the actual legs of this trade, we're looking at buying one lower strike call, and we're looking at selling a higher strike call. Now, the difference between that two, if we buy a lower and sell a higher, is going to be your debit, because what you learned in the last session is that lower strike calls are higher priced and higher strike calls will have a lower premium. So the difference between the two, when we merge these together, is going to be your debit spread cost. All right, for example, XYZ trading at 35. If we buy an XYZ May 40 call and sell an XYZ May 45 call, then what's happening is we're paying for the 40s, we're taking money in on the 45s, and the difference is going to be the debit that we have.
Sure. And going back to the introductory part of the DVD, remember what you've done. When you buy a call option, what you've really done is taken on a right to buy that stock at that price. In this example, we have a right to buy the stock at $40, XYZ at $40 if it's above $40. But now what you've done by selling it a call option is you have an obligation to sell that stock to someone for $45. So if a stock goes from, if you have a right to buy something at $40, you have an obligation to set it at $45, you've only got that $5 you can make, money on, but of course you also paid to do this trade.
Some details to notice. Number one is that we're using all calls. Number two, we're using the same expiration month on the calls we bought and the calls that were short. Number three, we're using the same ratio of calls to buy as we are to sell. And the other thing that we want to make...
What do you mean by that, just to clarify that? I can do one bull call spread, or I can do 5, or I can do 10, but whatever I buy and sell have to be the same numbers, correct?
Yeah, that's right.
Okay.
And then if you look at the slide that I've got up now, I'm showing a bull call spread versus a long call. The long call is in the dotted blue line. The bull call spread is the solid line you see here. This, again, shows that an example of how one can be done at a cheaper price than buying a call, where we're simply just buying the lower strike, selling the higher strike, and we're doing this for a lower break even because the higher strike is going to help us pay for what that lower strike cost us. So for an example, if IBM were at $85 a share, we could buy the 90 call for $5. We could sell the January 100 call for $3. And if you would have bought just the 90 call, you would have paid $5. But since we're doing this on a spread, we're buying the 90, selling the 100, we're able to do that for, in this case, as a cost of 2. The debit's going to be the difference between the two option premiums, which we see. The risk is the debit paid. The reward is going to be the distance between strikes. Now look at what we have here. We have 10 points between 90 and 100. We paid 2 for that 10, so 10 minus 2 is 8. 8 is going to give us our maximum reward. And the break even is going to be the lower strike price plus the debit, which the lower strike price was 90. The debit was 2, so my break even is 92.
So you have a right to buy the stock at 90. You have an obligation to sell it to someone at 100, so you can only make $10. If you didn't sell that 100 call, it could keep going up and you still make money, but this is a bull call spread. So in this case, you paid $5, you took in $3, so the net effect is $2 out of your pocket, and that's called the debit.
That's right, and the next slide is going to show exactly what George just said. We buy a IBM January 9100 bull call spread for 2. So we have the right to buy IBM at 90. On the left-hand side, you see the 90 strike. We have the obligation to sell at 100. And George, if this worked out the way I want it to all the time, then I would love to buy IBM at 90 and be forced to sell it at 100 all day long. I'd do that all day long.
I would do that my entire life if I could do that.
Now, the thing is that there's some factors in there as to why that doesn't actually happen, but it can happen to you, and if it does happen to you, that's great. You just made a maximum profit. Now, what I want to do with the next case before we talk about how to enter this order is let me show you using some live computer results what this means. So we talked about a stock in the last session called eBay. And I want to turn you to an eBay example. So what we're going to do is I'm going to come out here and I'm going to look at eBay, and I am going to buy a long-term. Let's say that long-term, George, you and I love eBay. And so we're going to go all the way out to some leap options. And what we're going to do is we're going to buy some leap options. Did you know that eBay is one of those stocks where if you want to buy some at-the-money leap options, you're going to pay $20 for these leaps? Sure. It's expensive.
I remember during the internet age when the internet stocks were going crazy and options were $30 a piece, which is $3,000 for one option. It was very expensive to just buy call options, so bull call spreads made a lot of sense at that point.
Yeah, so what I'm looking at here is if I were to buy one call option of eBay at $20, actually just a little bit more than $20, I'm risking $2,000 per position. Now realize this, folks. This is on a stock that's trading that would cost me $9,000 to buy the stock. Now a leap is going to give me the ability to actually get into the position for over 2 years. In this particular case, it's 2.5 years on the leap we're looking at. Now, how can I lower my position to where it's back down to a reasonable, respectable level? Well, one way I can do it is with a bull call spread. So if I go back to my graph, and what I'm going to do is actually go back and I'm going to create a new strategy. And this time what I'm going to do is I'm going to go in and I am going to buy the same options, those $20 options, at 90, but then look what happens. I'm going to go ahead and sell the $100, and those I'm going to get almost 16 points for those. So now what have I done? if we go back over to our graphs, what you're going to see when I put this together is we've got a couple of different risk graph positions here. And let me just turn a couple of things off here so you can see exactly what it is what we're looking at here. I've got two positions now looking at eBay. I've got, first of all, I've got one position that's going to cost me over $2,000. Now I've got another position that's only going to cost me about $400. So now what have I done, George? I've lowered my cost and I've lowered my risk by buying the spread instead of going out and buying the call option. Now, the other thing I'm doing is I'm lowering my break even, because if I come in here and take a look at this, you're going to see my break even on this position is in essence much, much lower. In fact, at expiration, my break even is going to be very close. It's actually just below 95, where if I bought the original call option, let's go look and see what the break even is on that. The original call option break even, I'd have to go above 110. So where would you rather be, George, at a break-even of 95 or a break-even at 110?
I like 95. Well, let me ask you a question, Tom. Why did you, we picked eBay, we like eBay, we thought it was a great company. Why did you go out to these long-term options called leaps?
Well, because first of all, if I'm a newer investor, okay, if I'm a novice investor, I'm just getting started in options, do I really want to be playing around with the short-term options, or do I want to understand looking at options from the long-term coming back? I think I want to start out long and work my way to the shorter-term strategies. There's an old saying that if you don't know what the temperature of the water is in the pool, you stick your toe in first instead of diving head first. And, sticking your toe in is like you trading a long-term option. The problem with long-term options are they can be expensive in this example. So by putting on the bull call spread, we've reduced our risk from the long option to the bull call spread by 80%. Instead of paying $2,000, we're paying $400. And here's another point I want to make out too. You realize that at break even on the call, when you finally get the break even on the call, if you would have done the bull call spread, you'd be at maximum profit already. So that's another thing about the bull call spread. Now, although it has a limited profit range, you could be coming up the curve on eBay, and by the time you got to the break even, you'd already be at max profit looking at this bull call spread.
So really what a bull call spread, what we're trying to do once again is we're trying to lower our costs. We got to find a security that we want to trade this in, and there are many ways we can do that, and we'll explain it during the series, the DVD series. You have to figure out the time frame at which you want to have this trade, and what we're saying is that there's lower risk in going a little longer term than there is in the shorter term. You have to react a lot faster when you're doing these short-term trades versus the longer-term trades, and I can tell you some of the best trades out there, Tom, and I'm sure you'll agree, are those that you just put on and just walk away from.
You know what? I've had some of my best trades of ones that I've put on and literally forgot about them. And now I can tell you that's not the way of money management. But one thing that a lot of folks just like you at home are doing when you get into trading is some of us don't want to become day traders. I mean, I'm not a day trader, and I'd say the majority of people I meet do not want to be day traders. So trading short-term options is in essence very close to day trading. There's not any hard fast rule. In fact, there's some guidelines that we'd like to give you, but there's no hard fast rule on what time frame makes the best spread. But I'll tell you the ones that I like to stay away from myself is I will not put a spread on an option that's 30 days or less. Because you're just not, if you're going to trade something in the short term, it doesn't make sense doing a spread. A spread is really designed for a couple of reasons. The spreads are designed for higher dollar stocks, anything that's over $25 a share, then you've got the ability to actually spread. Number two, what a spread really works out well for is these long-term options that are expensive. I mean, they may be cheap in terms of monthly price, but still, paying 20 points for an option, that's expensive. The one way to reduce that risk is by financing that option with another option.
Right, because when you've been doing this for a long time, I mean, one of the important things we try to do to increase your return on investment, you keep your cost of doing business low. Sure. And if you're going to buy an option for $2,000, it's a lot of cost, a lot of risk. But if we can help finance a portion of it, in some cases a very large portion, then what you can do is increase your return on investment.
So we've talked about bull call spreads, what they are, how they're structured together. And before we actually talk about entering the order, George, this is a question that comes up a lot in the seminars, and that's, depending on where the stock price is, where do I put my bull call spread? Do I put it below the stock price, at the stock price, above the stock price? Where's the best place to put this thing?
Let's go ahead and illustrate. Let's say a stock is trading presently at $90 a share. Right now, for those of you who are just starting to trade, remember when a stock is trading at 90, the options right around where the stock is trading, they're called at the money. So 90 is at the money. And we're going to be talking about call options. Remember, call options are the right to buy a stock as the buyer, an obligation to sell stock as a seller. Okay? And let's say I have the 80 call, the 85 call, the 90 call, 95 call, and let's say 100 call. What you're dealing with here is what's called the strike prices. Any call option below where the stock is trading, these are in the money calls. So the 80 and 85s are in the money. You've got the 90s at the money, and the ones above 90 where the stock is trading are called out of the monies. So these are out of the money calls because the stock's at 90, but if you buy the right to buy it at 95 and it's only at 90, it still doesn't have value. So if you wanted to create first, let's call it an in the money call out, an in the money bull call spread, you'll be using, let's say, these two strikes down here. You can buy one of the 80 calls, you can sell one of the 85 calls. If you're going to be doing what's called an at the money bull call spread, you'll probably be using the at the money options, let's say, or you can go slightly in the money, or both could be at the money and then one out of the money. So you can be going, let's call this an at the money here or here. Okay. So an at the money bull call spread, you could either be buying the 85, selling the 90s, or let's say buying the 90s, selling the 95s. Okay. And let's go for the last one, which is where both legs being out of the money. Okay, in this case, we buy the 95s and sell the 100s, and here you've got an out of the money bull call spread. What's interesting is you're going to want to use these at different time periods. Tom, when would you use an in the money bull call spread?
Very short time frame to expiration, and with high volatility.
Okay,
and it'd be very, very similar to a covered call, which I know some of you guys know what I'm talking about. And this isn't exactly my favorite strategy, but one way to create a covered call is you can use a surrogate for the stock. So you can use an in-the-money option and then write an at-the-money option. You've now created a covered call look that looks like a covered call, works like a covered call, but probably has about 80% less risk because now you're using an option instead of place of the stock. So if the thing falls off real hard, which we've seen them do before, you won't lose any more than the cost of the spread.
So what you're saying is if you're going to use an in-the-money one is very short term, I suspect what you're going to say is I use an out-of-the-money bull call spread for more time frame, longer time. So Tom, so to finish up our graph here, the way to maybe do this is say that as time goes on, you're more likely, as time increases, to go more out of the money because there's more likelihood that this stock could actually move into that range. So let's say I've got a stock at 90, I'm more likely to do a 100, buy the 100 call, sell the 110 with a year to go than I am probably going to do it with 30 days to go. Am I correct?
That's right. And we've got, there's a stock like, for instance, using a stock like Research in Motion. Now, here's a stock that has doubled, went up, stock split, it did 2 for 1. It's gone right back up, and it's back up to where it was back practically before it split. This stock's moving around a whole lot. This is a great opportunity of putting on a long-term spread that's out of the money. If you think that the stock's going to continue to move at the rate of speed it is. So what I did was I dialed in on a computer, and let me just show you what I'm looking at here. This is a great example of a couple of things. First of all, this is a leap. This is a bull call spread using leap options. If I were just going to simply go out and buy this the call option on its own, this one call option on its own is going to cost me $14.50 just to get into the call option with a strike price of 100.
Which is $1,450 because you're controlling 100 shares of stock. That's
right. But what I was able to do was go in here and buy the 100 call and then sell the 120 call. Now, they're 20 points apart, 20 points between the prices. And I'm able to do that right now for a cost of about $400. So we're cutting off 2/3 of the cost by going in and financing the position. So the other thing I want to show you, too, is that we're doing this for about a $400 cost. There's a $1,600 maximum profit, as you can see here. Now, the blue line here represents today, and the black line represents break even. I want to really show you something here because, this stock will max out if we're at the price of 120 or greater on expiration day. Now, because this has so much time built up in it, and a lot of people who start with bull call spreads, they start thinking immediately that they're going to get a maximum profit just as soon as the stock hits 120, and that's just not so. Because if you've got something with 2 to 2.5 years on it at expiration, and in 6 months it goes up to your sell strike, you're not going to get maximum profit because there's still 6 more months of time built up into this thing.
Tom showed you a good example of what's called the risk graph, and let me just show you the way that I like to think things through, especially for the beginners. If I go ahead and I buy a call option at 100, and then I've got the stock ability to go up to 120, you know that this is my potential reward. The reward is a stock. I have a right to buy something at 100, I have an obligation to sell it at 120. But you know that I paid some money to do this. So along the way, as Tom said, I paid $400. So you know that if I can make the $20 or $2,000, but I paid $400, my reward's going to be $1,600 on this trade. Okay, and that's really what I like to do. I like to think it through. If it was a 120, 130, and I paid less of a debit, that's the way you always think things through. And then I take it and put on my risk graph and see whether the trade makes sense. Tom, why don't you give us an example of how to put one of these orders on?
Okay, yes, good timing too, because now we've talked about bull call spreads, and we've even shown you how we kind of fish around for the strike prices that we like. And again, one additional way I like to look at this is I'll look for a target price of where I expect the stock to go. That's usually going to be the sell side of my bull call spread. So if I expect eBay, for instance, to go to 120, then I will try to put together some sort of a spread where 120 is the call I'm selling. I may be buying the 110, I may be buying the 100, but I'm still looking at that 120 as my target price. Okay, so going back to our IBM case, let's take a look and see what we have here. If this is a spread, I want to buy X number of contracts of IBM January 90 calls and sell X number of contracts of January 100 calls. Remember, what we're buying and what we're selling are going to be equal amounts. So if you buy 2, you sell 2. If you buy 5, you sell 5. For a debit, in this case, remember back at our example, the 90-100 bull call spread can be done for a debit of 2. So we're going to do this for a debit of $2 opening both sides. Couple points. Number one, this is a spread. I try to enter the whole thing as a spread. I don't care about putting the January 90 calls in at 10 and putting the January 100 calls in at 8 or whatever the individual prices are. Those don't mean anything to me. I want to put this whole thing in as a spread for one price. Number two, says a debit of $2. Now that means $2 per contract, but that doesn't mean if you're going to do Q contracts that you want to put it in a debit of 4. It doesn't matter whether it's 1 contract, 5 contracts, 10 contracts. You're quoting the contract price per contract.
That's correct. The other thing is you got to realize some of you will be doing this through computer. How does it work differently versus calling in versus a computer, Tom?
Well, computer is a little different because, each brokerage firm is going to be a little different, but you got to have the strike symbol. You got to have the actual option symbol to put in. And luckily, you and I can't remember all these symbols, George.
No, definitely not.
But that's what the computers are there for. You can actually bring up the symbol lookup, and it'll make sure that what you want in terms of strike price and expiration match the symbol that they have in their database. And it's just a matter of putting this information in, hitting an OK button. Almost every broker I know wants you to reconfirm that order, to read it back to yourself, make sure it looks good, and then confirm it by clicking OK. And then, depending on whether you're doing a market order or limit order, will also determine how fast that order gets filled.
Right. So understand how your broker handles this. If you're going to call somebody and give them the order, they're going to want it a certain way. And if you're going to put it on the computer, there's going to be a certain way that your broker's going to want you to do it. So make sure to understand that. Now that I've got this trade on, Tom, how do I get out of it?
Okay, well, depending on how many weeks, months, or even years sometimes you could be in this trade, at a certain time you're going to want to exit the trade. Now, we have some rules on when we like to exit, and we'll save those for near the end of this session. But when you're ready to exit, you got to remember that you're now going to take this trade and reverse it, and you're going to be doing it for a credit. So, for example, let's assume that our IBM debit spread went from $2 to $4. So now we've made a 100% profit on our trade. And let's say at that point you decide you want to take this off. So looking at the computer again, we'll exit the same way we entered. This is a spread. I want to, but now we're going to reverse. We're going to sell the IBM January 90 calls, and we're going to buy back the IBM January 100 calls, and we're going to do this for a credit of 4, closing both of our positions. All right. Before we opened the positions, they became part of our account. When we closed them, they exited our account, and what came back in? the credit, the 4 points per option spread credit.
So really, and one of the big mistakes I've seen, and people mention it, is let me ask you, Tom. What if I just close one of the legs? What am I doing there? And a leg means one of the options. What have I done at that point in time?
Okay, well, you're leaving yourself open to some additional risk. Maybe some additional reward if you get lucky, but most of the time it's going to wind up being additional risk. Now, let's talk about each one. Let's say you close the buy side. Well, you have to have the ability to have short margin or short